History repeats itself on Wall Street. The same patterns that preceded every major crash are appearing right now. Can you spot these 3 recession indicators before it's too late? Telltale sign, number 2. Manufacturing contraction and employment warning signs. The global manufacturing sector has been flashing serious warning signs over the past 6 months. The Global Manufacturing Purchasing Managers Index has steadily declined to 47.3, well below the critical 50-point threshold that separates growth from contraction. This pattern mirrors what we saw in the months leading up to both the 2001 and 2008 economic crises. But manufacturing isn't the only sector waving red flags. Employment indicators, often the last to show weakness before a major downturn, are deteriorating rapidly. Initial jobless claims have surged 15% in just 3 months, while wage growth has slowed dramatically to just 2.1%. These are classic precursors to the unemployment spikes that accompany full-blown recessions. Perhaps most concerning are the sector-specific weaknesses emerging across the economy. Technology companies, often the canary in the economic coal mine, have already cut 23,000 jobs in Q1 2025 alone. The construction sector is following suit, with project cancellations accelerating. These employment warning signs, combined with manufacturing contraction, create a powerful predictive signal that shouldn't be ignored. Smart investors recognize these patterns from previous pre-crash periods and are repositioning now rather than waiting for headlines to confirm what these indicators already tell us. The global economy is flashing red alert signals we haven't seen since 2008. The escalating US-China trade war has reached critical levels, with China implementing unprecedented 34% retaliatory tariffs. This isn't just political posturing, it's creating real-world supply chain chaos. Essential components aren't reaching manufacturers, consumer goods are stuck in transit, and global inflation has surged to 8.5%. These conditions mirror the warning signs we saw before the 2008 financial crisis. The markets are responding with unmistakable panic. The S&P 500 has plummeted 9.08% in just 3 weeks, while the tech-heavy Nasdaq has crashed over 10%. This isn't normal volatility. It follows the exact pattern we've seen before major economic collapses. The rapid acceleration of these declines suggests institutional investors are quietly preparing for worse to come. Perhaps most concerning are the revised forecasts from leading economic experts. The probability of a global recession has been raised to 60%, far above the typical 20,030% forecasts we see during stable periods. Central banks worldwide are running out of tools to prevent what's coming. The economic storm clouds are gathering, and time is running short to prepare. In the next sections, we'll explore the specific warning signs to watch for and exactly how you can protect yourself from what's coming in 2025. Our third and final warning sign might be the most alarming of all: asset bubbles and irrational market behavior that mirror previous historic crashes. Let's start with real estate, where danger signals are flashing red. The current price-to-income ratio has reached a staggering 8.7, far exceeding the 7.2 levels seen just before the 2008 housing collapse. Even more concerning, we're witnessing a sudden 12% drop in sales volume, a classic indicator that the bubble may have reached its breaking point. The speculative fever isn't limited to housing. Today's markets show disturbing parallels to the dot-com bubble, with meme stock mania driving irrational price movements. Meanwhile, exotic derivatives, those complex financial instruments that few understand, have surged by an eye-popping 340%. History teaches us that when investors pile into investments they don't comprehend, disaster often follows. Perhaps most telling is market sentiment. The fear-greed index recently swung from extreme greed 82 to extreme fear 23 in just 45 days. This volatility isn't random. It's a historical precursor to major market corrections. Smart money recognizes these patterns and positions accordingly. These warning signs don't guarantee an economic collapse, but they demand our attention. By understanding these signals, you gain precious time to protect your wealth before the masses rush for the exits. Let's examine our first warning sign of the impending economic collapse: credit market freezes and yield curve inversions. Right now, credit spreads have widened to an alarming 450 basis points, a clear signal that lenders are growing increasingly fearful. We haven't seen spreads this wide since just before the 2008 financial crisis. When credit markets seize up like this, it's like the economic circulatory system is developing dangerous clots. But that's not all. The yield curve, one of the most reliable recession predictors in history, is flashing red. The difference between the 10-year and 2-year Treasury yields currently sits at negative 0.75%. This inversion is significant because similar patterns have preceded every single recession since 1955. When short-term debt becomes more expensive than long-term debt, it signals serious economic distortions. Perhaps most concerning is the explosion in corporate debt. The corporate debt to GDP ratio has reached a record high of 52%. This mountain of obligations makes companies dangerously vulnerable to even small interest rate increases or liquidity problems. When businesses are this leveraged, even minor economic shocks can trigger widespread defaults. These three indicators, widening credit spreads, inverted yield curves, and record corporate debt, are creating the perfect storm conditions, and history shows they're reliable harbingers of economic collapse. Understanding these warning signs is your first step toward protecting yourself from the coming crash. As dark economic clouds gather, let's focus on 5 powerful strategies to not just survive the coming collapse, but position yourself to thrive in its aftermath. First, defensive portfolio positioning is critical. Consider shifting to a 30,000 40% cash position, providing both safety and dry powder for future opportunities. Allocate 15,000 20% to crisis-resistant sectors like consumer staples and healthcare companies, selling what people need regardless of economic conditions. And don't forget a 10,000 15% allocation to gold and precious metals as traditional safe havens during monetary uncertainty. Second, strategic debt management becomes essential before credit markets freeze. Aggressively reduce variable rate debt exposure, particularly credit cards and adjustable rate mortgages that could become crushing burdens when interest rates spike. Conversely, consider locking in long-term fixed-rate debt while rates remain relatively favorable, especially for cash-flowing assets. Third, prepare your opportunity watch list. History shows the greatest fortunes are built in times of crisis. During the 2008 collapse, Amazon fell 65% before delivering 4,000% returns. The 2020 COVID crash saw quality blue chips drop 30,050% before robust recoveries. Start building your watch list of financially strong companies with depressed valuations and distressed real estate opportunities, focusing on assets with strong fundamentals but temporary price dislocations. Remember Warren Buffett's wisdom: be fearful when others are greedy, and greedy when others are fearful. By implementing these 5 protective strategies, you won't just weather the coming economic storm, you'll emerge stronger and wealthier on the other side. History repeats in markets, but knowledge is your shield. By recognizing patterns, you've already taken the first step toward financial resilience in 2025 and beyond. Subscribe to RockVein now and join our community of prepared investors. Comment below with which warning sign concerns you most, and share this video with anyone you want to protect before the 2025 downturn.